Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
And I'm Kelli Saunders, Vice President of Policy and Engagement, filling in for Sarah Miller today. We'll kick off the show by welcoming Future Now Services LLC from Bingham Farms. So welcome, Robert Skinner and your team. And of course, we are welcoming our new member by our sponsor, Consumers Credit Union. I want to thank them as well. Make sure to visit consumerscu.org to learn more about how they can best support your small business needs. So Brian, we have a very full show today, so we'll kick it off, but let's start with jobs. The July report came out last week, so what did it show us?
Well, first of all, it was another up month, which was not a surprise. It came in at 187,000 jobs to the good, and they also every month when the new numbers come out, so these are July numbers, when the new numbers come out, they also review and adjust the months before. So additional data comes in, and before, when it looked like things were pretty even, you can actually see really over the last year a pretty marked downward trend in the number of jobs, which is what the Federal Reserve has been looking for, a little bit of pressure off the jobs market, which would be an indication that inflation is likely to ease in the future. So for quite a while, 200,000 plus jobs a month had been kind of the going rate, if you will. And so now it's got a couple months that have come in under, looks more like that soft landing. Also, the average hourly earnings rose about 4.4% from a year earlier. That's actually a little bit more than expected. So it's kind of, just, again, some little bit of crosswinds here, but things pointing more to a soft type of a landing when it comes to the fight against inflation and the risks of recession. I think that this jobs report is just more evidence of that.
So we're up 187,000 overall, but what does it look like between industries?
So the industry is a different story, of course. There was a time, like, right after the pandemic and all these trillions of dollars and federal dollars going into the economy, like everything was up. It's not like that now. The biggest one was healthcare. So 63,000 in healthcare. We're going to look in Data Monday at a bar chart that gives different industries, and they put in that category is healthcare and education, which are both heavily influenced or direct government services in some cases, that were about 100,000. That's the vast majority came from those industries. Looking at the others, well, even like hospitality and leisure and hospitality, an additional 17,000, but that's slowing as well compared to previous months. The big one, like manufacturing, for example, is pretty even all year, pretty even. Down a little bit this last month, actually, down a little bit. So if you look at the overall industry by industry breakout, you definitely can see a much clearer picture of the slowdown that's happening. But at the same time, the total hours worked in the last month, that did soften a bit, which would indicate that employers, at this time when there is, things softening a little bit, are less likely or less inclined to let people go or lay people off, but maybe back off hours a little bit instead. And then the biggest, in terms of the biggest loser, temporary employment services. So this is the one that had really been, it's the heyday for a while after the pandemic, and just lots of demand for where can we find people. And the temp services has definitely cooled off. That was, of all the different categories, the one that cooled off the most.
So what we hear you saying is that jobs are slower, but still up. Unemployment is low. Yet Wall Street saw some very large declines last week. So what is shaking investors? Yeah,
it's, of course, every investor, it's in the eye of the beholder in what's happening, but there were really I kind of think of three different categories that are shaking investor confidence as they kind of look over the horizon. The big one that was kind of a surprise was that Fitch, a credit rating agency, they do like ratings of corporate bonds, but they also do governments. They do local governments, state governments, and the federal government. They actually downgraded the federal government's credit rating. So it went from AAA to AA plus. And while that's still a strong rating, the US federal government, their treasuries, their bonds are generally considered to be the risk-free rate. And the idea that there'd be a credit downgrade, and Fitch insists that they just looked at it just like they would any other organization that they're doing ratings on, and they had seen some kind of consistent trends in terms of their confidence and the overall. They actually referred to governance, that there'd been a decline in governance, and the period that they referred to as 20 years. And frankly, probably a lot of people would agree that in terms of the federal government's ability to just kind of govern in a partisan divide, and just kind of the difficulty to get pretty simple things done, a steady deterioration in governance over the last 20 years. But they were also looking at the traditional things like the total amount of debt and the rate at which the federal government has gone into debt in recent years. These are all things that played into it. It did draw kind of a sharp response back from Janet Yellen, the Secretary of the Treasury, that the decision was arbitrary, and but very clearly it had an impact on Wall Street and investors last week. So I think this week we'll see whether or not they kind of shake it off. Do things go back to normal? Is there a response by the federal government? I guess we'll just have to wait and see.
So that is a big change, but you said 3 things. So what are the other things that we need to know?
A couple other things. First, there's always this kind of tug of war going on between interest rates and to cool inflation. So inflation versus recessionary risks, and the fact that the fact that you see the Federal Reserve has removed their projection that there will be a recession in the next year has really kind of widened the path for them to really be even more aggressive on inflation. So I think that there's certain segments, certain sectors of the economy that look at this clear lane where the Feds aren't so worried about recession anymore. They're going to continue to increase interest rates. So capital intensive industries would be potentially have a steeper hill in front of them, more slowdowns that could happen as a result of that. The other big thing is just the stronger and stronger indications that the labor environment is going to get more difficult. We've talked a lot about the labor environment when it comes to just availability of people, like where have all the people gone? It's shrinking workforce overall, and a lot of those are like demographic or generational changes just in the size of the generations. But what I'm talking about here is not that. I'm talking about union negotiations. They're getting rougher than they had been for a while. We saw kind of things brought to the brink with UPS. UPS carries about a quarter of the parcels every day. About 6% of US GDP, at least according to UPS's estimates, are carried by them. And so there was some pretty rough and tumble negotiations that were happening, and they, because just couldn't let the company shut down, the cost structure within that company is going to rise pretty significantly. That is kind of an indication of what I think more and more industries are just expecting in their future. So future profitability and rising costs. If you think we've already had rising costs that could get a lot tougher. So let's talk a little bit about the UAW and the negotiations with the big three. So we've talked a lot about the new president of the UAW, Shawn Fain's been very aggressive, more so than what we've seen in quite a long time, and really decades. And he did a Facebook Live, and he just laid out what the demands are, made them in a very public way. Now, I think that the amount of like the scandals of recent years, people going to jail, and just the things that have happened within the major unions in the last few years are one of the reasons why he would just put everything out there. Like, this is a new day. We're not going to negotiate in secret. But it also kind of puts some lines in the sand. And And usually you don't put out there exactly what you're demanding on day one, because then it's harder to compromise later on when inevitably people have to compromise. But I want to give you a sense for what has been publicly put on the table for the UAW agreements or UAW negotiations with the big three, and Michigan's big three anyway, General Motors, Ford, and Stellantis. So elimination of wage tiers. So there are different tiers depending on when you were hired. So elimination of the wage tiers. They're looking to go to a 32-hour work week. So instead of a 40-hour work week, a 32, so a four-day work week. And now it doesn't mean that that people would necessarily be working any less, but when they were working 40 hours, it would be overtime after 32. So you get a sense for how these things kind of stack up on each other in terms of overall costs. The looking for pretty substantial wage increases, 20% immediately and 46% over the life of the contract, which goes to 2027. So a 46% increase in labor costs is what they're bargaining for. Restoration of cost of living allowances, the defined benefit pension for all workers. So bringing back, remember, before when General Motors went into bankruptcy, when Chrysler went into bankruptcy, the defined benefit pension programs were a big part of just how that not enough workers in the future to support those in the past, but to bring that back, reestablishment of retiree medical benefits. Again, another really big piece of the cost structure that there is no way that that cost that anybody's figured out yet anyway, that a corporation can remain sustainable with these types of things. But these have been put on the table. So you stack them on top of each other. 32-hour work week, 46% wage increase, bringing back defined benefit pension plans for all employees, giving all retirees of the companies medical. So in retirement, not just when they're working for the company, but after they're no longer working for the company, and then giving more paid time off, limits on the use of temporary workers, additional strike allowances for when a plant has to be closed, and increasing the benefits to current retirees. So, though it's when you see all those things, I think the idea of UAW or the UPS going to the brink, and then UAW positioning this way with major industry in an industry that's capital intensive, and the higher interest rates are likely to soften the market anyway. All these things add up. You can see why investors and corporations might be a little nervous that the sustainability and the future profitability, and therefore how good of an investment these companies really are, would be somewhat shaken.
Well, we'll continue to watch that for sure. We're going to switch gears just a little bit, but since the pandemic, it's inspired more reshoring, and relations with China have cooled. So the U.S. trade picture has shifted pretty substantially, we can say, just due to a couple of those things. What are you seeing in the year-to-date on the Census Bureau data?
Yeah, I love the Census Bureau data. We think of it as like population, but they keep track of everything. And one of the things is the trade that we do around the globe, and who the biggest trading partners are. And if you were to back, say, in 2015 or something, you look off into the future when Canada and Mexico were our biggest trade partners, you'd say, yeah, but in the future it's definitely going to be China, and they'll end up overtaking everybody else, and maybe by a lot. And China has been our biggest trading partner for periods of time in recent years, but that trend has actually fallen off quite a bit. And there's several reasons that is the case, but it's worth noting that like year to date, actually Mexico is our biggest trading partner, not China. And over the last few years, since 2018, has traded off between Mexico, Canada, and China. So if you're to think about all the things that have happened, first of all, back, you remember there's a lot of controversy back when the Trump administration had put tariffs on imports from China. The Biden administration, even though there was kind of some political back and forth on it, they never removed those. Those are still in place today. And so that, of course, had some impact on it. Wages for Chinese factory workers have risen. And this is what happens when there's investment and there's all this stuff happening. Cheap labor doesn't stay cheap when there's a lot of demand for it. And so what's happened is that competitive advantage where they could say, hey, we're cheaper. Yeah, they still are cheaper, but the difference between it is not what it used to be. And when you put on top of that the uncertainty of supply chains and moving things across the globe, and then you put on top of that the type of cool relations that China and the United States have had in terms of their bilateral national relationships, that is the corporations that make these types of investments and where they source things, that's a risk that they have to take into consideration. And that's why I think you see more and more companies that are looking at it saying, well, if I want to stay in the neighborhood, I want to stay in Asia, places like Vietnam are getting more attention. And while the other options aren't necessarily as well developed in terms of the infrastructure to get stuff in and out, the ports, the airports, and the factories and the transportation systems, those aren't as well developed in other countries as they are in China, but in terms of the other Asian countries, but there's more and more business that's going that way. And then, but of course, Mexico and Canada, being very close trade partners with the United States, have been natural places to catch some of this, and then reshoring to the United States. Electronics has been a big part of this change, and then Japan is actually buying a lot less from China as well, and but European countries are staying pretty level in terms of what their the overall percentage anyway. Right now, of the imports purchased by U.S. citizens, about 1/6 of them are Chinese imports, but just a few years ago it was 1/4. So it gives you a sense for the type of dilution that they have experienced. So I was actually there were a couple of percentages I was going to refer to. I'm not coming up with it immediately here. So yeah, down to here we go. U.S. imports from China were down 24% for the same time period a year ago. So year to date this year, 24% less than a year to date last year. So pretty big difference, and it's for a lot of reasons. And by the way, none of those reasons are going to stop anytime soon. All the conditions that I referred to that have led to this kind of slowing of that trade relationship are highly likely to continue in the future. So where it bottoms out, not really clear, but a totally different picture than practically anybody would have predicted, say 5-6 years ago.
So now let's go from international to stateside and focus on some things that happened in the last week here in Michigan. The governor signed a new executive directive on permitting. If you want to take a minute to explain what an executive directive versus what an executive order might be, and then what does this one mean? What does it mean here for folks in Michigan?
Yeah, an executive directive is not as big a deal as an executive order. So an executive order is going to either impose certain types of regulations supposed to be based on laws that exist, how government is organized. An executive directive is an order to your existing operation. So it's basically saying to the departments, a directive, do these things. On permitting, a lot of this is an intention. So these aren't things that have happened yet, but the intention is to establish guidelines for permitting to get answers. So somebody applies for a permit, they get everything they need to have in, then there's a set guideline or a standard developed to say it has to be, you have to give an answer back by this date and or this many days. And if you don't, then you need to refund the money for the permit to the citizen or to the entity, the company, the local government, whoever it is that needs to permit. That's the intention behind it. But the directive starts with this. What are all the things that we do permits for? Everybody in state government, what do we permit? And what do we permit for? And what are your standards for those permits? To report that back to the governor's office, where they will then review, work on establishing those types of standards and a system to track those standards, and to have essentially a penalty in place for when the government does not meet those standards. So certainly a good effort. So we'll see how it turns out, but it was a directive that was issued last week, and one that was definitely welcome for any of those industries, especially since the pandemic, that have that rely on permitting from state government. We do hear reports pretty commonly that it just takes longer to get an answer, whether it's yes or no, to get an answer back when you're waiting for permission from state government.
Well, we definitely like more effective and efficient government. So we will hope that this produces something that is long lasting and making sure that our members can get through permitting processes quicker. Let's shift to unemployment. We have talked about unemployment fraud on this briefing for many years, specifically in regards to the pandemic and the debacle that it was. So cleanup on unemployment fraud continues. Can you give us an update on what the latest is in regards to that?
Yeah, there's more criminal charges. This time it's the federal government that has filed federal prosecutors announced charges, criminal charges. So these aren't civil, criminal. People go to jail probably, against 11 Michiganders, 11 people in Southeast Michigan. And they're accused of fraudulently obtaining $4.5 million in unemployment benefits. And they did this by collecting personally identifiable information, social security numbers and dates of birth from people, unknowingly applying for unemployment on their behalf, and then taking the money. So they would have had to have been pretty elaborate, setting up bank accounts and things like that. And so when I say bank accounts, probably wasn't bank accounts, probably was the online payment systems. But in any event, it was a group that, what I was kind of surprised by, is a group of 20 somethings. And imagine if you put that type of 20-something-year-old, put that type of ambition to work out there in an economy that demands people so much now, and how much more productive that could have been. But they still, this work, these investigations and rooting out this fraud and putting people in jail that committed the fraud, it continues. So real pleased to see, in this case, the federal prosecutors that are taking some aggressive action and making an example out of the thieves.
So now let's shift to some recall petitions that you have talked about in previous small business briefings. They were filed against, I believe, 6 or 7 legislators. So can you give us an update on the several steps that are in that process and where we are today?
Yeah, there were 7 recall petitions filed against 5 Democrats and 2 Republicans, and 6 of the 7 were rejected by the board of canvassers. So the board of canvassers has to do a clarity review, and they said, and so before you can go out and get petition signatures from citizens to put somebody on the ballot for a recall, it has to be approved by the board of canvassers for clarity. And some of them just said, so-and-so, this representative voted yes or voted no on voted yes, and in these cases, on a bill, and it gave the bill number, but it didn't say what the bill number did. Mark Brewer, who's an attorney that argued before that these ought to be thrown out, successfully argued that it's not clear what the issue is. You can't expect somebody's going to know what a bill number really means. The one that did get approved was Representative Cam Cabot from Northern Michigan, and it said that they were recalling him because he voted no, or he voted yes, or voted in favor of Joe Tate as Speaker of the House, which, if you know anything about the system, doesn't make really sense to try to recall somebody because they voted for a particular speaker. That's decided by a caucus. In this case, Cam Cabot is a Republican. Democrats have the majority. They chose Joe Tate as their speaker. And then it goes up to a vote for the whole House of Representatives. And usually on day number 1, traditionally what happens is that there's a unanimous vote for the new speaker. It's a showing of bipartisanship. It's largely symbolic because the majority caucus has the votes. And so it would be unusual. A few representatives did vote no, but pretty much everybody voted yes. And that's the reason that was cited. And it's not whether or not it's a good reason, it has to be clear. And in his case, it was clear enough to make it past the Board of Canvassers. And so there's a petition. They still have to get signatures from people in that district. And then even if they get the signatures, it's not just recall yes or no, but the opposition would put up a candidate, and it would be essentially a midterm election.
All right, well, we will continue to watch that. But before we get to Data Monday, an interesting survey of employers by the American Society of Employers returned some interesting results about workplace flexibility. Can you give us a breakdown of the highlights of that survey?
Yeah, I thought it would be worthwhile just to show how common different types of flexible work arrangements are coming. So one type of flexibility is remote work. 82% offer at least some of their workforce remote opportunities. 82% of employers in the survey. 64% offer flexible hours. 58% offer leaves of absence that go beyond the family medical leave requirements, the legal requirements. 42% or 24%, sorry, offer paid parental leave. And there was some parts of the survey that talked about how it's usually the decisions in terms of how to be flexible and do the remote work is not like a rigid top-down thing, that managers have the flexibility to run. Most companies are going to that type of a system. And then when it comes to sharing costs, 87% supply a laptop or a computer for remote work. 46% cover office supplies, 28% cover printer ink, and it's fairly uncommon to cover internet service at somebody's house, and fairly uncommon to cover office furniture for somebody's house. 5.9 is the average number of weeks allotted for paid parental leave, which is, I suspect, is quite a bit different than it would have been if you did that same service, say, 10 years ago.
All right, well, let's go into high-speed Data Monday.
All right, so let's check out Data Monday, and I've just got 4 slides. There's a lot of great data on these 4 slides, but the first that we're looking at in the left-hand part of the screen, these are the monthly jobs reports going back a year. And so you can see clearly kind of a downward trend, but not a sharp one. So this was soft landing, and having 2 months under 200,000 jobs after so many in a row over is a pretty good indication of that soft landing, but not so much a recessionary risk in the same sense of previous periods of high interest rate and high inflation. Speaking of which, on the right side of the screen, you see wage growth in green, and then overall consumer price index. Now you'd look at this and say, wow, that looks great. Look, inflation's come way down. It's lower than job growth, but inflation only came down because of the fast moving things, not core inflation, but because gas prices came down, because home heating fuel came down, because commodity food prices came down. And so when you see those things come down quickly, it's not necessarily doesn't mean that inflation is like we've got it under control. It just means that those volatile parts happen to be working in our favor right now. It's the reason why the Federal Reserve is still not confident. Looking at the jobs growth, again, on the left-hand side, you see health and education, over 100,000 jobs. Construction still added, leisure and hospitality still added, government still added. It was really business services and manufacturing that were a little bit down. But overall, if I were to pull out the jobs report from a year ago, you would have saw a lot bigger pluses here. I was to say these are kind of coming down. The prime age, the labor force participation rate for the prime working age, that 25, this says 24 to 54, but it's actually, I think, a typo from the author of the graph. It's 25 to 54 is the range, and it's 83.4%. So that part is really recovered. That's high. In fact, it's an all-time high. If you peel back though the jobs report data, you'll see that part-time jobs for last month were way up, and full-time jobs were actually down. And so that's, some theories as to why that would be, but just understanding that it's not, everything is not up. And then looking at the percentage that have left their job, this is an indication of a tight labor market, and that's staying high, 14.6%. People voluntarily left their job, and that is a pretty strong indication that the leverage that workers have right now is still really, really high, and that one of the reasons why there's a lot of confidence the Federal Reserve can be very aggressive, continue to be very aggressive on interest rates without leading to a recession that comes with high unemployment. That's what we have for today.
It is. We had a full show. I just want to remind everybody that if you are in the Kent County region, we do have an owner-to-owner meeting this Wednesday. If you want to visit sbam.org/events, you can find out more information there. And Sarah will be back with you on Monday. Thanks for joining us and have a great week.
Thanks, everybody. See you next week.